Hello Internet, I'm Jackie Fox, and in the next couple of videos, we're going to be talking about zombies. They're not necessarily fast zombies, in fact they move pretty slow when you think about it, but they are incredibly powerful, with some having similar power to that of some nation states. That's right, today we're talking about zombie capitalism. Patient Zero. This is going to build a bit on my video about who is rigging the economy, because a lot of the same plot threads are going to come up again. And this time, we will be going a bit deeper into this, starting with Larry Fink. Our story starts with Mr. Fink in the 1980s, working at an investment company where he invented the idea of the mortgage-backed security. He was doing particularly well at his job, managing over $1 billion. He was the talk of the town, until, of course, he lost $100 million of those dollars in some pretty risky bets. Remember, kids, the stock market, derivatives, cryptocurrency, options trading, all of these things are very much just more expensive ways to gamble with your money. Now a bit of a pariah, he decided to make a new name for himself by starting the Blackstone Investment Company. Wouldn't you remember being one of the ones that I talked about in the last video? And again, if you haven't seen that one, it's really going to help you with parts of this. So Larry has a bit of a disagreement with one of his co-founders in Blackstone and decides, fuck it, I can do this one more time, and decides to start his second investment company, BlackRock, which you also might remember is the other company that I talked about in the last video. That's right, they're so incredibly similar because the same man started both, and I guess he's not very creative with names. I mean, I'm imagining he has a son named Lawrence and a younger brother named Larry Jr. and an older sister named Lori. Now, I mentioned a number of differences between Blackstone and BlackRock in my last video, but one new difference is that BlackRock uses a proprietary supercomputer system called Aladdin to analyze a lot of proprietary data within the market to determine potential and possible outcomes in order to guide investing, and perhaps even more than BlackRock itself, is trusted with people's monies. Other groups routinely pay for the services of Aladdin, with both Aladdin and BlackRock combined controlling over $20 trillion in the global economy. This is part of what I meant in my last video series on cybersyn and cybersocialism, that many of these systems, such as ones that can predict markets based on massive amounts of data that already exist, are real things, and they are currently being used to benefit the capitalist companies for their own benefit, as opposed to being used for the societal benefit. Okay, I need to explain capitalism and fictitious markets before I get much further. Broadly speaking, capitalism is a system where people can invest and get returns on their investment. This is more efficient than the systems that came before it, which did not really have an investment system. They were basically just the king held all the money in a cave, guarding it with a dragon or whatever, and instead it allowed a method in which money could benefit the world around them instead of just sitting there stagnant. One way of thinking about this that might help you is that capitalism likes to keep money moving instead of sitting around. But why would a wealthy king just hand his money out, even if somebody was going to make something objectively really cool with it? Well, capitalism's core promise is that if you, a person with capital, i.e. a capitalist, puts money into the system, that you will get some growth in that, and you will generally get more money back than you put in. This creates a sense of faith in the free hand of the market, which will keep rising the value of everything until they have 3%, if not more, money every year. And in a world where a lot of wealthy people have faith in the stock market, prices go up and all of the capitalists make money when their money is returned to them with a handy profit. In capitalism, you try to do as good as you can, but as a government, you have to keep the investor class happy or you've done a bad capitalism. A capitalist government isn't there to be a liberal democratic state, so much as it is there to make sure that stock prices, on average, keep going up. And America, at least, has been really good at this, especially in the last century. Even so, the system has an inherent problem of infinite growth, in that it's basically a very slow Ponzi scheme. And as we've seen over the last 15 years, everything about our economic situation can and will be used to prop up that Ponzi scheme. But when you inevitably run out of new things to sell or new innovations to market, you have to start creating something called fictitious markets. And this is a good way to understand mortgage-backed securities, and especially just derivatives in general. because all of these things are just debts on something that has value, which itself is derivative from the actual thing. Sorry, to quote the IMF, financial derivatives are financial instruments that are linked to specific financial instrument or indicator or commodity, and through which specific financial risks can be traded in financial markets in their own right. What that means is that basically you can effectively bet on something in its own market, which creates a new product that is only valuable relative to a certain change in something else in the market. When Redditors noticed that investment firms were buying derivatives that were betting that GameStop would lose value, this is called shorting the stock, they were able to crowdsource a rally for the stock, meaning that the holders of those derivatives would be forced to lose a lot of money on their bets when stock prices instead went up. And you can add a whole extra layer of derivative, which essentially creates a derivative on a derivative. So now we have like nested fictitious markets that have slowly developed as capitalism basically runs out of ideas on how to be organically profitable. And as capitalism becomes more and more desperate to create new and profitable fictitious markets, we're going to start seeing wilder and wilder things become the object of speculative investment. But put a pin in that idea for now. I'm definitely coming back to it in a later video, and you probably already know what this is about. Let's instead fast forward to 2007 and 2008 as the United States is experiencing a massive housing crisis. This alone would be bad enough. However, because of derivatives like mortgage-backed securities, thank you again, Mr. Fink, for inventing those, and especially those, in addition to other things like collateralized debt obligations, all of which is rely on the idea that the housing market would always be stable and therefore never lose money. And all of a sudden you had a place where the entire market was propped up by what were considered to be derivatives that were immune to failure and also quite profitable. And derivatives like these played their part in making BlackRock such a monumentally successful and influential company. But when they failed, this not only threatened their company, but the rest of the market and the entire system of derivatives had long been too big to fail, in that if any major derivative ever did, major banks who were holding people's money were so disproportionately exposed to risk, like billions of dollars more money than these individual banks held, meaning that they could just lose all of your money if even one of these systems went belly up, like we saw in the housing market. Well, this had pretty dramatic effects that absolutely destroyed most smaller banks which were relying on this investment strategy because it seemed like such a sure thing. In the public, we largely worried about a run on the banks, a la 1920s, even though the FDIC, which has been implemented since, insures bank deposits up to $100,000. In terms of who it saved to, quote-unquote, bail out the banks, well, it was people with investment capital and huge sums of money sitting in their accounts, not people who had less than $100,000 to their name. So, of course, this was much bigger than just the banks. It felt as if the whole rug had been pulled out from under the economy, as so many institutions were invested in this same sure thing. I remember about 5 banks on Main Street of a town near where I grew up, and now there are 3. And as of the pandemic, all 5 of those have been bought out and replaced by the likes of what I had previously considered to be big city banks, like Wells Fargo and Bank of America, not the local banks that I grew up with. This was a massive hollowing out of the banking system where the big banks, through loans that BlackRock set up for them, bought out all of their local competitors, spreading their tendrils into the smallest corners of small-town American life. Now, I'm definitely not saying that we should have done nothing and just let the whole economy die, but what we did wasn't to rehabilitate it and make it more resilient to this type of failure in the future like we had in our response to the 1920s and the beginning of the New Deal political era. In fact, we seem to learn almost nothing from that experience because one of the ways that we had to implement it to keep this sort of collapse from happening in the future was the implementation of something called the Glass-Steagall Act, which separated banks from investment firms and kept your money safe in case of a speculative collapse. Then, in 1999 and 2000 respectively, the Clinton-era Congress would pass the Financial Services Modernization Act and the Commodity Futures Modernization Act. The former, despite its name, resets the banking rules to their pre-Great Depression state, and the latter expanded the deregulated futures markets, which, now that I say it, feels a lot less like learning from mistakes and more like making them again with more enthusiasm this time. Before these changes, no matter what bubble happened, your local bank would still have your money because they weren't invested in such things, and instead they were more invested in the local economy through loans. But in the space of about a year, Congress saw fit to get rid of that, and not even a decade later it had destroyed our economy, and yet, since then, we have done very little to reverse course from this mistake. But make no mistake, no matter what we did or could have done, the economy as it stood at that point and how it had worked nearly died in the moments after Lehman Brothers collapsed. It was actually a little bit amazing that we are losing this game, and so we just changed the rules. And what rule did we fundamentally change to put our economy on life support? Well, the Federal Reserve, with its power to print money, did an unprecedented things and set the printers free to blast all of those BlackRock-involved banks and companies with massive amounts of loans at near zero interest rates, basically free money. Now, I had a very well-educated friend tell me that this isn't as nefarious as it sounds because these loans will have to be paid back at some point, and at which point they should move off the Fed's balance sheet. At this moment, looking at the Fed's balance sheet, though, you can see how it's either steadily increased or the Fed is just handing out more and more over time. Of course, it did hand out a lot of money in the early pandemic to keep the stock market from completely collapsing, but even before that, the amount on our central bank's balance sheet seems relatively stable. In addition to that, it wasn't just a loan, but a loan at exactly the right time to be able to buy up all of their competition and make the American economy generally less competitive by weeding out a lot of smaller businesses, especially in crowded financial spaces. As we see over time, this increased the divide between the wealthy and the rest of us. We've been growing up in a two-tiered economy, and at this point I think it really bears looking at the last decade to show how different things work, because the 2010s feel almost unprecedented economically, at least as far as America is concerned.